In commercial real estate, acquisitions and development roles often get lumped in together when talking about different career paths, but each of these are going to give you very different experiences. These include different day-to-day responsibilities, different people that you'll be working with, and even different considerations for real estate entrepreneurs that are planning to go out on their own. So in this video, I want to talk through the main differences between a career in real estate acquisitions and a career in real estate development, and which one might be best for you based on what you're looking for. So let's start by talking about careers in development first, where you're working on the acquisition of raw land parcels and the construction of new buildings. On a day-to-day basis, when you're working in development, a lot of your focus is going to be on project management, construction oversight, and constant coordination with capital providers, including both equity investors and lenders that will very likely need to fund your projects over an extended period of time. Development roles also typically require a lot of work directly with city planning departments and local government officials to get projects approved, and you'll also be spending a lot of time with general contractors, architects, and structural engineers to design projects that both pencil and are also attractive to tenants. And on that note of making deals pencil, development roles also often involve a lot of what's referred to in the industry as value engineering, where you're constantly going back and forth with these construction and design professionals to create the product you're looking for at the lowest possible cost. Taking a development project from start to finish can also take a really long time, and in some markets, it can take years just to get a project approved, on top of another few years to actually build the project, and then another 6 to 9 months or more to lease up the property and stabilize the asset. This can be really tough for people who like to see quick results and the tangible outcomes of their work, and especially for real estate entrepreneurs that are just starting out and reliant on fee income in order to keep the lights on. Development is also a really high-risk part of the business, since construction costs, market rents, interest rates, and even investor demand can all fluctuate significantly between the time a parcel of land is acquired and the time a property is operational. Now, on the other side of the spectrum, one of the best parts about being in development is that you are actually building something new from scratch and creating something that's very likely needed in the area it's being built, whether that's a warehouse that can ship products to customers more quickly, clean and safe, affordable housing for individuals and families, or even just a more convenient place for people to shop that's much closer to their home or their office. Developer fees can also start to become substantial as you get into bigger projects, since these are often calculated as a percentage of the total project cost, and these fees are also usually not reliant on the performance of the investment itself, meaning that developers can still often make great money even if the market turns during the construction period. Now, on the acquisition side of the industry, where you're working on investments in existing properties that are already operational, your day-to-day responsibilities can look substantially different for a few different reasons. First, in these roles, a lot of your work is going to be focused on analyzing cash flows that already exist with in-place rents and expenses that are known variables up front, and a lot of the assumptions that you'll need to make from a financial modeling perspective have often already been proven out to some extent at the property. And because these properties are already operational, these will also have in-place leases at the time you're underwriting a deal, meaning that acquisitions jobs, especially at the analyst level, also usually require a lot of commercial lease review and communication with attorneys. And since the property that you're analyzing has already been built and approved by local governments, you typically won't need to spend months or years going through the permitting process or diving deep into the weeds on complex zoning laws. And because of this, the acquisition of an existing property usually won't take more than about 60 to 90 days between the time the property is identified and the time the transaction is closed. And for real estate entrepreneurs, acquiring existing properties can also be a faster path to generating revenue, since you'll typically earn an acquisition fee as a percentage of the purchase price of the property up front, an asset management fee as a percentage of the income generated from day one of ownership, and also potentially construction management fees on construction projects that can often be started just a few months after the property is acquired. Now, a downside of working in acquisitions is that because the acquisition of existing properties does tend to come with less risk than you'd see on ground-up development deals, this also usually comes with lower expected returns and a much lower cap on your upside. Also, if you find a lot of value in creating something new and building something that wasn't there before, working in acquisitions can often feel really transactional, and even if you do renovate a property, you're not creating something new that wouldn't have existed without your input. Now, acquisitions and development roles also typically require significantly different relationships, which is also something to consider, especially if you're not sure which path you want to take. Land brokers typically don't sell existing assets and vice versa, and the people you'll work with when building new product aren't likely going to be the same people you'll work with when acquiring existing properties. This can make it pretty tough to transition between these two career paths, especially as you move further into your career. So if your main goal is to be a developer and you know that up front, starting out in acquisitions and spending 5 to 7 years there can ultimately cause issues when trying to make the switch. At the analyst level, I've also found that acquisitions pay does tend to be slightly higher than what you'd see in development, which is likely a product of faster fee generation and the additional technical skills that are often required when analyzing things like in-place commercial leases, historical financials, rent rolls, and financing structures that often don't come into play immediately when acquiring raw land. And as far as personality types are concerned, people that come from backgrounds in industries like construction or architecture often make really good development professionals, since they typically really enjoy the planning, design, and construction management process, and they're also used to spending a lot of time and effort on a single project, whereas people who come from industries like investment banking, general private equity, corporate finance, or sales often do best in acquisitions roles with high levels of transaction volume and detailed granular analysis. I've also found that across the board, people who do well in development also usually have a lot more patience, and this is especially true early on in your career, since projects can often take 2 to 3 years to complete, and you might not even see your deals come to fruition before you end up leaving to work for a different shop. Ultimately, either of these paths can lead to a very lucrative and fulfilling career in commercial real estate, but it's important to know what you're getting yourself into by going each route. And if you want to make sure you have the technical skills you'll need to land an acquisitions or development role at a top commercial real estate firm and pass an Excel modeling exam that might be given to you during the interview process, make sure to check out our all-in-one membership training platform, Breaking the CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Breaking the CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on the channel on careers in acquisitions or development, make sure to hit the like button and let me know. And let me know in the comments which of these paths you're most interested in and why that's the case. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.